Good day, fellow investors. It's that time of the quarter again. We go to JPM's great slide for JPM's guide to the markets. I know you always enjoy this, the market, how expensive those are, where are we in the economy, recession, inflation, interest rates ahead, inverted yield curve, and international valuations, then a conclusion and my opinion on the great data that JPM puts into the slides. However, that great data there is for one reason, and that is for them to sell, of course, to their clients and to present a brighter picture for what they do. They do an amazing job, but it's important to know the mechanics of things. And there will be one theme through the whole slides this quarter that will really give you some different insights onto investment banking, investing, finances, and the bright picture versus reality. And in that bright picture, the last few months, the stock market did 24%. Everything looks good. Inflation is subduing. Interest rates are about to go down. So nothing to worry about when it comes to investing. But you can see here, over the last 8 months, stocks have been going only up. Before that, for 8 months, stocks have been going only down. Before that, only up, down, up, down, up, down, up. So when it comes to investing and the stock market, it all looks like most people just look for direction, not fundamentals, not value, not intrinsic values. And that is our greatest advantage as value investors. We do not try to get the right direction because few survive this that are chasing direction. This is 13 years of zero. Therefore, of course, 13 years of a great time is excellent. But if you want to invest, then you invest so that no matter where the direction of the market is, you do well. That's value investing. And that's also the perspective I'll give you through these slides. Because the value investing mantra is to look, okay, price is what I pay, value is what I get. And here you immediately see how, again, the forward price earnings ratio at 19, you would say doesn't look even high, doesn't look crazy, but it's already a bit higher than the 25-year average and closing in on one standard deviation. But this is the forward price earnings ratio that is made on positive future estimates for earnings. However, if I look at the real current P ratio, it is already 25. So you would say 100 divided by 25 is 4%. That's the earnings yield. Looking at the forward P ratio, you are 5%. So investment bankers will always show you the nicest picture up there. But yes, the last 25 years you have an average. So you would say the market is not expensive. But look at the century before that. The average was 15. So if that happens, then the market still has room to fall 33% just to get to the average. And then if it overshoots, then you are down 50%. And that's a direction I would not like to be in. But many of you investing in the market are risking exactly that at these valuations and levels. Now, it is a little bit calmer here. You see here the valuation spread, and you can see here the dot-com bubble, how there were crazily valued stocks, and you can see here the tech bubble, again, crazily valued stocks that now has subdued, but the range of valuation is still extremely wide. So this would be something more normal, but you can see here how there are still expensive stocks, but there are also some cheaper stocks. Of course, value investors will look later on international businesses where the cheaper things are for, let's say, lower risk, higher returns. Let's continue on the rosy glasses that everyone on Wall Street has. If we look at earnings, these were the 2021 earnings, 2022 earnings. We had an earnings recession, and earnings actually fell from $210 per S&P 500. If you look at the S&P 500 as $4,400 to buy one, those fall to 180, something like that. But what will happen? Okay, this year a little bit better, but then boom, boom. So already analysts know that over the next 3 years, earnings will go to 275 for huge growth, and that's why this looks good. What will happen to stocks? Stocks will go up, and who cares about the P ratio of 25? Just boring value investors when everything looks so rosy and everything will go up. I do not understand, maybe I'm not smart enough to understand how it is possible that all these things just go up forever in eternity. Might have studied too much history, too much reading, who knows. Maybe I would just need to go to work for an investment bank to see what they are seeing, because I'm simply not seeing it. If I look at profit margins, those are sky high compared to historical averages. If there is competition, those margins might be a little bit lower for a while, and also you can see those margins in many sectors are on the higher end. And yes, you are the happiest person in the world to pay more money for your electrical bill and everything else. So that's something that might be one of the impacts, especially if people start being fringy, and we'll look at the consumer a little bit later. However, value had a little bit of the resurgence last 10 months as the market was crashing, or before that, but lately again value is going down as we are back to growth stocks and comments, look at this, how it's going, Nvidia, etc. So that's normal for value investors. We do not look cool for a long time, especially the 15 years that growth destroys value, but when there is a crash, then value investing looks a little bit better and allows for compounding over time. This is a beautiful chart, and perhaps something that is important to comment here is the generational shift. So we have seen the market goes up to 4,500, 400 points. Everything is good. The Fed will solve anything. And if you look at the crisis over the last 20 years, there was practically only these two crashes, a little bit more, and then the Fed intervened, printed money, and saved everyone's behind. So that's very interesting how this generation from the 1990s is used to the Fed saving everything except for this a little bit, but especially this. Since the financial crisis, stocks have done 3x, and it looks like nothing can stop it. I'm always looking into what if the paradigm shifts, what if something different happens, what's my downside protection. And for a lot of people, pension funds especially, as we will see towards the end of the slideshow, it looks very, very ugly. And you can see here the duration of bear markets and bull markets. So bear market, 9 months, already over, 1 month, 17, and we have to go to 2000 to see a 30-month bear market, and then back to the 80s to see a little bit more normality and a little bit longer, bigger, uglier situations, especially this 15 years. I think that given the growth since here, this block, then we had 15 ugly years, then we had 40 great years, and now we are for a 15-year ugly block, especially for real returns. Let's discuss the economy. Now, again, this is a beautiful chart, but I think nobody wants to watch it. So, first, the federal net debt. The CBO forecasts just a year ago in the quarterly were something like this. Finally, they understood, okay, this debt is just going higher and higher, slower, but it's going higher and nobody cares. The government can just keep on borrowing as much as they want just to pay interest, which is the definition of a Ponzi scheme, and nobody will ever complain. And you can see here now the new chart, federal deficit at net interest outlays. Just interest is now making half of the deficit. This is crazy. If interest rates stay higher, you cannot, what is this, 4% of your GDP is interest payments, and then you borrow more to pay those interest payments. This is really crazy. Plus, again, rosy projections. Over the next 10 years, the economy will grow at 2% and even 2.5% from 26 to 27. But 2023 is just 0.3%. Like here, there will be no recession. Here, there will be no crisis that pushes this up, that creates more needs for this. And to me, this is simply insanity that nobody is looking at those numbers. At some point in time, people will understand these numbers, and then it will be ugly. Personal savings rate, okay, people are overspending their excess savings. That's still keeping the economy up. Spending, saving levels very, very low, like in the great times before the financial crisis. We will see what and when will happen, but again, ugly, 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 as they say. Inflation, however, is going down. The Fed did a great job, so no worries about inflation anymore, going close down to where it was, and the Fed will then be able to lower rates again. That is at least the expectation. If we look more into detail for inflation, we have shelter a little bit, restaurants, hotels, transportation, other food, and new and used vehicles and energy are not the components anymore. So when that happens, it might also lead into a recession, as people are or buying less or getting things at cheaper prices. But also this means lower margins, and those are the margins that are included, the high margins, into the earnings growth forecasts. If we look at oil prices, again, much lower, so going already at 70. Wake me up when we cross 40, then we'll again make a video on buy oil stocks now and make money. But for the rest, lower prices means less inflation. That is logical. And this is perhaps the most important chart for projections here. And that is that, yes, the Fed might push it a little bit higher, but then 2024 already lower, 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 and we will go back to 2.5% Fed long-run projection, 2.5, which means a P ratio of 25 for the S&P 500 is a great one, forever there, 30 even better in good times, and that's why you see stocks going up. Plus, you see stocks going up, nominal yields on the 10-year treasury are, yes, close to 4%, but people are expecting lower inflation, lower Fed rates. That's why they are locking in this higher rate, but still accepting a negative real rate. And locking in future higher rates means that the yield curve is inverted, because people are happy to lock in 4% for 10 years rather than getting 5% for a year, 2 years. That's insane. And I don't think that these guys will be lucky as the projections are, because of the debt, the everything, the issues we have seen. This is solved only by inflation, a little bit higher inflation. So we will see whether these projections will come true. If not, then it will be very, very ugly for most of the market chasing that direction. But rosy projections are there. Inverted yield curve, less investments now, should lead into a recession if we look into history. And then also maybe everyone is thinking these levered loans cannot sustain 11%. Municipals cannot sustain 6%. So mortgage-backed securities, they would be better at 2%, 1% rather than 5%. Real estate collapse at 5-6% is what you can expect. So high yield 8%, low investments, so nothing works as it has worked. Therefore, everyone is expecting the Fed to lower, but that might then again lead to inflation. So we might have a roller coaster going on the next 10 years, even if everything looks great now. Next crisis, what will central banks do? Pump money again. But because that's all they know how to do. And how was the 2007 financial crisis solved? So that the amount of debt out there went from 70 trillion to 140 trillion. So that's a 2x in debt. That's how you solve a debt crisis. Let's now dig into global equity markets, where it looks like people are a little bit more rational. If we look at the ways and the market capitalization, I recently had an email saying how I have few stocks that I cover that are traded in the United States, even if I have 2 out of 3 in my portfolio traded in the United States. But okay, 62% of the global market cap is in the States. While the States, I think they make 20% of the global economy, and that number is declining. So you can buy the rest of the world at a much cheaper price, lower valuation, and maybe we will see an inverted thing over the next 15 years. And it's already now emerging markets globally are doing a little bit better. So we'll see whether we will see these things compared to the US having done great the last 15 years. Of course, 2 standard deviations price to earnings discount towards the US. And also there is now a higher and higher difference in dividend yields between the US and the world. So Europe is getting cheaper, therefore I'm researching it more and more. There are crazy old-fashioned businesses, but there are also good things, and that's why I like to look into my market, and not that attracted anymore to emerging markets research, because I know this better, thus less risk for similar valuations. And then you compare it to the US and everyone is flocking to the US, the herd is going there. We as value investors look where others don't look. Of course, I still have some investments in China, we'll always look at it, but for now focusing on European stocks. Those are also traded in the US if you want to check my research platform. If we look at manufacturing, a little bit more towards the orange. Germany is flirting with a recession, UK, so not really great across the globe. China has its own issues, but okay, we will see whether there will be a global recession slowdown or we will just stay in this orange limbo for a while. Inflation is slowing down a little bit, but don't think it's gone. I would not say it's gone. Depends on the money printing that will be next. Maybe we'll have 2 years of a break and then boom again in the next crisis. We will see. And long term, thinking of inflation, 8 years, what's this? 1.3 billion people will enter the middle class. That's more than the EU and the US put together. That's a lot of demand. That might make us live in an inflationary environment no matter what we think about. China has its own issues and you can see all the headlines, but okay, they are still working, they are still there is still the demand, they still have also their own things. Now, we have alternative assets that are very, very interesting. And then again, investment banking. A few years ago, decade, 2 decades, they started offering alternatives and now they show how the returns were higher on alternatives and the volatility was lower. Thus, this diversification was the best, even better than those that risked everything in equities. And then the worst ones were those that were into bonds that were promoted highly. Pension funds, I think they have 60% of things in bonds. Crazy to invest in bonds at 2% yields. What do you expect the returns will be? Well, they expect the returns to be 7%. How to get to 7 if you invest with 2? That's a crazy expectations for me. Even 6 is a little bit high. Now they expect that equities will do greatly, but if equities don't do well, and fixed income, they all have those piles of fixed income giving 1-2%, then pension funds won't make any money in the next decade. We discussed this in a video, this one, so check it out. The next crises are already brewing. So I'll change the title to pension funds so that if you search my name and the crisis, you will see it. Now, on my opinion here, crazy markets, no fundamentals whatsoever, it's insane. Stocks always go up is the mantra, following the trend, the trajectory of the market. The Fed will lower rates, inflation, there are no issues, no wars, no nothing. What if it doesn't happen and we have a crisis 6 months from now and we are again 30% down? That can happen, like it can go up 20%. There is no value in it, and therefore it's extremely risky. Now, piling government debts, everyone is just borrowing like there is no tomorrow. There is no tomorrow for the currency. There is no other option, which means inflation, which means crazy interest rates, which means roller coaster riding for the next 15 years, up and down. Too risky for me to just play around with it. So everything that we have seen in the charts is based on the rate decline projection. If that doesn't happen, therefore, I prefer to look for good businesses internationally, P ratios of 10, dividend. I think we have one with a yield of 20%. We even discussed some on YouTube with 10%-ish interesting good businesses. So pension funds, SE9, as we discussed here. And the solution to everything is to invest in yourself, for yourself. You build your own wealth. So think about what do you get when you invest into something? How will that compound over the next 20, 30 years? No matter what happens, the projections you have seen, earnings had to grow already 2022, but then they crashed by 15%. There was an earnings recession, but the projections are always rosy, always great, but you have to think conservatively, invest in a way so that whatever happens, you end up okay. Try to start thinking in that way, which means cash flows, yields, value creation, not promises. Everything in this presentation was a great promise sold by Wall Street to the Fed, to everyone, and that's very, very dangerous. Thanks for watching. Check what I do. I'll see you in the next video.